Welcome to today's webinar, compiled and produced by the team at biznews.com. All of our webinars are interactive. We encourage you to pose questions to our guests. The more challenging, the better. And the earlier you get the questions in, the better the chance of having them answered. The recording of this webinar will be available later today on the biznews.com channel on YouTube. Do you like that, guys? Nice little bit of music to start us off with. Bit jazzy, isn't it? Bit funky, jazzy. A bit American in a way, I suppose, Martin, which is where you are talking to us from this morning, your time, lunchtime, noontime, our time. Or what time in the morning is it there?
It's just gone 6 o'clock in the morning, Alec.
Thanks for getting up early for us. Justin Clark, who's the other director of OrbVest with us today, you're a lot closer to home.
Absolutely. Sunny Derbs today, Alec, down on the North Coast.
We've had quite a lot of discussion over the past few months, and it's lovely to see the way that OrbVest is growing. But today you're taking the wraps off another new project. So without further ado, Martin, as a CEO, I'm handing over to you. You can take us through. Just before we get going, though, Stuart Lohman, our general manager, your name's a bit too close to Stuart Bailey's, Stu. I don't know why I always get the two confused. Maybe because we worked together as long as I worked with Bailey for. But would you just give us some insight into the tech?
Excellent, thanks, Alec. Yes, quickly, let's just do a quick sound and video check. There's a little high five button on the attendees control panel. If you can give us a high five, if you can hear my voice and see Justin, Martin, Alec on screen with the presentation underneath. Let me see, got some high fives, virtual ones there, Justin, all good? Okay, cool, great stuff, thanks all. As Alec's intro mentioned, we do like to keep it interactive. There's also a little questions bar on the control panel. If you put your questions in there, Alec can pass them on to Martin and Justin as they run through. But all good this side, Alec.
Brilliant. Well, those questions are the core of the program. We already see there's quite a few questions. Somebody said they can't hear me at all. Well, I hope, Yolanda, you can hear me now. Certainly Martin and Justin, thumbs up, you can hear me? Perfect. Okay, we'll be on to that in a moment. Thanks, Simon. I can see Nick, Michael already posing questions. We'll get to those later. Martin, if you'd like to just take us through a little bit about who OrbVest is, I'll play with the slides or turn the slides over, and perhaps you can just talk to them very briefly and then get into the project number 29. Which I'm sure most people are really interested in finding out more about the investment potential.
Thank you, Alec, and thanks for having me on the webinar today. So for many of your listeners who know about OrbVest, I'll try and keep it short and brief. OrbVest is a global real estate company. We essentially started in terms of investing overseas and diversifying our wealth. And as you can see on the screen, we have a hyper focus in medical office buildings in the United States only. What that means is that we acquire the buildings in the United States and we raise our equity for these buildings globally. Currently, we are raising equity from over 10 countries, including China, Brazil, UK, various other countries. In fact, it's been gratifying, Alec, to see in the last couple of months, we've now got investors from even Uganda, Kenya, Saudi Arabia, United Arab Emirates, and it just continues to grow and grow. So it really is extremely humbling.
Well, there's a slide on the screen telling a little more about you, but perhaps we can bring in Justin and he can tell us a little bit about himself before we carry on with the presentation, because I guess people want to know who you are too, Justin.
Yeah, Alec, I think you've made Martin more famous than he really is. But just my background, for those of you who don't know, I guess I have had spent the last 20 odd years in digital real estate. I co-founded a company called privateproperty.coza, that for many years was the leading real estate platform in South Africa. We then expanded and ran out over and around Africa, backed by Tiger Global Management, and opened up across Africa various different classifieds, which was a lot of fun, Alec. And now I've met up with Martin and this team at OrbVest, and I must say it's another very exciting chapter.
And the point that you were making a little earlier, Martin, which might have been lost on people, was that you said we saw this as an investment opportunity. So actually, OrbVest began with a bunch of entrepreneurs who were looking to invest their own money internationally, and that's one of the reasons why we were attracted to you as a business partner. I'm sure others would be too.
That's 100% correct. So when we were each trying to find our own journey of investing somewhere in the world, investing overseas is not easy. It takes a lot of money, it takes a lot of time, effort, and knowledge, and you really need a team to do it. And over time, the IP has been harnessed, the skills have been brought together and developed into systems and processes, and it's a lot of hard work, but once you get it actually into a proper business and a strategy, it really grows from strength to strength, because most people in the world do want the same thing. They just want to put their money somewhere safe, know that it's generating dividends in a foreign currency.
Okay, so let's get back to the OrbVest story. Who is OrbVest, or what is OrbVest?
Well, I'll leave Justin to take a look at this slide. Justin knows these numbers very well, and not only that, it really just encapsulates who we are in one simple slide.
Absolutely. So in a portfolio value, I think, Alec, we have acquired these buildings for the last 6 years. Currently, we're sitting, between 300 and 400 million. Why that's a little vague is obviously we have signed purchase agreements on buildings that haven't closed out yet. So that's why that number is a little loose. But we manage, guys, over 1 million square foot of real estate. We look for unicorns. And I say that because people say that the returns are almost unbelievable. We aim at between 11 and 17% IRR. Just a note, remember that is forward-looking. And we pay out a cash and cash return. And so far, we'll show you a little bit later on how that works out, but it's roughly 2% a quarter, or 8% per annum. And as Martin mentioned, investing globally and investing in the US is generally quite complicated. We have made it simple through our structure through the Seychelles, and you can invest for as little as $5,000, which makes it really accessible to the average investor. So that's the summary of where we're at, Alec. I think talk a little bit to healthcare, Martin. I'll take this one. Why do we focus on healthcare, and why do we find healthcare such an interesting niche? Well, the first thing is that healthcare is, if you think about your doctor or your dentist, and you think about how long they've been in the building that you've been seeing them in, you'll find that they seldom move. They move once or twice in their career. So it is very interesting. But in the US, there's a bunch of other things that really matter, and that is the population is aging. And if you have a look at this graph here, in 2040, they have over 18 million people that are over the age of 65. Now, why do we mention the age of 65? Because people over the age of 65 generally require a lot more healthcare than that demographic below 65. So that's why that is specifically relevant. Aging population is very important to us, and specifically the healthcare niche is very attractive for a number of different reasons. Alec, I think we can move on. Of course,
and talk about our performance over the period from 2014 until now. And as you can see, when we say 8% per annum in dividends, that's what we target. So if we find a building that'll generate, call it 6-7%, we won't look at that building. As the market becomes more competitive, obviously you'll see the rates possibly trend downwards, just because healthcare is now being accepted as such a resilient asset class. But you can see the performance. The last few buildings, what we have is we've acquired the buildings as a value play, meaning that overall the project will generate 9% average cash on cash dividends, but it may start in the first year, call it 5,7, and then in year 2 it'll jump to 7 or 8, and then 9, and then 10. So you can see that our performance is that we look for buildings that generate around 8% cash dividends per annum. As an example, you put in $100,000, it will generate $8,000 returns. We pay those returns out quarterly. It's very important that everyone understands. We will never do a development. We will never do ground up construction. All our buildings are stable and are income producing on the very first day we acquire them. And that's the reason why they are so predictable. Each building obviously has its own standalone building that you're investing into. So some may be slightly higher, some may be slightly lower. But that really in essence is the yearly returns. When we sell the building after 5 years, because we hold all real estate for 5 years, there is a profit generated. And if you take that profit and your cash dividends, that gets you to what's known as, Justin referred to, your IRR. It's your internal rate of return. It's the two combined.
Martin, just to jump in there, Simon McLennan asked a question which is relevant. You've just mentioned that it's a 5-year plan. Is there an early exit option?
We plan for 5 years only, and we tell people that real estate is a long-term play, because specifically when you go into a transaction, you're looking to go and acquire it on day one. If there's a small amount of vacancy, about 10, 15%, you want to find your tenant. You want the escalations to move up over time, because in America, remember, people buy buildings based on your net operating income. So you want that net operating income to increase over time. People also have the perception that in America there's no inflation. That's incorrect. There is inflation, and in fact, all leases have 2 to 2.5% escalation built into it. So hence it is 5 years. If people do want to exit earlier, there obviously is an active secondary market. It's not guaranteed, but it's willing buyer, willing seller. But also, you look to time the exit of the building when you've maximized the value. So if we get a great offer or the building's generated significant value add earlier, we may look to sell it earlier. But the maximum is 5 years.
Yeah,
Right.
Interesting point to make there is that we've had trades of over 5%. So people's life situations do change, and they do occasionally want to exit early. There is a lot of interest from people already in that building because they know it, and it's getting closer to the end, which is obviously where the sweet spot is. And as I mentioned, 5% of trades across our portfolio.
And here's the building that we're talking about today. Which of the two of you is going to take off the wraps?
Martin, you get it started.
So the first thing is that we as OrbVest have really been eager to get into a new territory, and that territory is known as Phoenix, Arizona. The state of Arizona is really popular at the moment. There is an enormous trend in America of people moving from the north of America, the cold, where I live in places like New York, down to the south towards Florida and Arizona, where two reasons. Number one, your climate is very favorable, as everyone will understand in South Africa, and also the taxation in those two states. It is very low, it is very affordable, and so those are two areas we've been targeting now for over a year. Difficult to find assets, and so I'm delighted to introduce this asset in a state that we've been working very hard with people on the ground there to find off-market transactions, which is the key to investing in the United States, finding good deals that are off-market.
So let me talk a little bit to Phoenix. Phoenix is very interesting. Apart from that growth from people that are migrating towards the warmer climates and the lower tax regime, what is interesting is that the city of Phoenix will be the 4th largest city by 2030, Alec, which is quite interesting. And the 2nd largest contributor to the local economy is healthcare and social. It's the 2nd largest employer in the area, which obviously bodes well. Pharmaceuticals is 15% of domestic production. And there is this very interesting, what they call the Phoenix Healthcare Research and Innovation Corridor, where all of this activity is happening. And the one thing we've learned is that if you want to acquire buildings that always are strongly tenanted and are sought after by the medical fraternity, you should be near or within a hospital campus. And so this absolutely ticks this box. As the map shows here, you can see that we are very close to the core of this Phoenix Healthcare research and innovation hub, and close to all of the hospitals, etc. There is a 36% projected employment growth in this particular sector, which is above the norm across the US. So significant growth expected in the medical sector. And I think also one of the other interesting points is that there are the most amount of active trials happening in this particular research corridor than any other area in the US, which I find quite fascinating.
Justin, it's also one of the, maybe Martin can confirm this, from what I understand, one of the areas that the retirees flock to is Arizona, and particularly Phoenix. I guess that's why you talk about it being the 4th biggest city in the United States. It's not going to be young people going there, presumably.
In fact, I can actually give you a personal experience. So my daughter, who's 21, her best friend, their entire family has just moved to Arizona right now. And so there is a strong movement there. And it's not just a few people, it's a large amount of people moving consistently there. It is affordable. As I said to you, it's just a great place to go and live, just like a lot of people move to Florida. And so, you know, with population growth, we believe as OrbVest, it's one of the strong fundamentals to real estate. Generally, if you have a good building with good tenants in a decent location and increases in population, it should be worth more, hopefully, in 5 years' time than it is today. We don't bank on it, but that certainly is one of the underlying criteria that we look when we look to invest and acquire.
Justin, just a small thing. There's feedback when your microphone is unmuted for some reason. So I'm going to mute you until you talk, or perhaps you could do that to yourself in future. It just makes it a more pleasant experience. Anyway, now I'm unmuting you. So you want to talk to the next one?
Thanks, Alec. I think you censored me. That's what it was. But there's no background noise, but I'll certainly keep it muted. I'll do it myself, Alec. Thanks.
Thank you. Right, on to the next. We got 14 questions, guys. So I guess the idea would be let's try and get through the presentation at a reasonable pace so that everybody can get their questions answered.
Right, maybe I'll talk a little bit to the building. So first of all, as I mentioned, very well located. If you look in the background of this particular image, there's the building in the foreground. There is St. Luke's Hospital. It's a 50,000 square foot building. And perhaps I should just explain a little bit about how we operate, because there will be people on the call today, Alec, that are not familiar with the difference between us, for example, and a REIT or a fund or whatever. So effectively, our core business is to acquire one building, and we list that building separately so that individual investors can actually directly own the building through a listed share. We identify these buildings specifically on certain requirements. We like them to be multi-tenanted. In the event that there is only 1 or 2 tenants, then we like the key tenants to be credit tenants, so that you're guaranteed to have income over the next decade or so. And ultimately, we look to exit over 5 years. This is a typical type of building, so a good one to talk about. You can see it is around 50,000 square meter. The current tenant who takes up 56% of the building is a Moody's, a AAA rated tenant, in fact, and an S&P. And you can see there again is another shot of the building, gives you a nice indication of all the other hospitals around and about. And there's been over $1 million spent on just refurbishing the car park. And there are some other investments that have been made by different tenants. But what is most notable is that the AAA tenant is, and you can move on there, Alec. The AAA tenant is a community college that trains nurses. And of course, the nurses service all of the hospitals in the area. So they are quite locked into the location. As I say, the tenant has just re-signed a lease for a further 10 years and have invested roughly 1.43 million in TI. So, you know, they are absolutely locked in there. On top of that lease, they have signed 2 5-year options. So, they're looking to really occupy this premises for 20 years.
If I can jump in here, Justin, and just mention that in terms of the tenant, they were supposed to be running the nursing college over 4 days in the week. Since the advent of COVID, they've expanded to running it at 6 days a week because the influx of people into healthcare in the United States has been phenomenal. The reason why is because a lot of people that were in other industries, unfortunately, have been furloughed, which means that they've had their hours cut down or they've been laid off or retrenched. And those that are in the healthcare niche have found that their jobs are in high demand. So there really has been an enormous amount of people flocking towards the healthcare sector in terms of employment. And we note that in the United States, that sector with the aging population is set for enormous growth, and it requires, in fact, further facilities and further people in that sector. So hence the reason why we believe this is a very powerful tenant currently performing incredibly profitably.
So, yeah, I'll take on here property rent. So this anchor tenant, as we call it, is paying $19 a square foot. Now that is a little bit below market. Why is that an advantage? Because if you have a tenant who's paying above market, the chances are there might be some downward pressure on your leases in the future. So there is only upside in the lease if something happened to that particular tenant. At $19 a square foot, they are running below the current norm, and you'll see the graph on the left-hand side shows that prices have inflated of rental premises in the particular area, in the Phoenix area, and the average rental price is 20.35. So that is actually a plus. There is another thing that we look for, and that is some form of value add in a building. The first value add that is often achievable is vacant space. This particular building, when we signed the PSA, had a vacant space. It's not a large vacant space, but our property guy is winging his way today to Phoenix to have a meeting with a series of doctors, and hopefully we can fill that space. We try and do so almost before the deal is closed, and we have a very successful letting history. So I think that is very interesting. The other one is St. Luke's. So the other portion of the hospital is occupied by Stewart Healthcare, which is the St. Luke's hospitals, very strong group of hospitals. They currently are not occupying the premises. Is that a problem or is it an opportunity? Well, it's not a problem because they are a very large group of hospitals and doctors, a large hospital group, and they are due to pay the rent for the next 3 years. So we don't have a problem with that. But what it does offer us is the opportunity to actually find a better mix of tenants that will complement the existing building. And of course, that we have 3 years to do. And so we see that as an opportunity to replace St. Luke's if they will give up the lease. And we will certainly be working on that straight away. There's a couple of other fundamentals that really, really matter. And that is, are you buying the building below market? You can see that our value, if you just go back a step there, Alec, right at the bottom there, we are paying $173 a square foot versus $304, which is the market average. That's the lower graph there. And then the other important thing is cap rate. We can probably get into a bit of detail about that later. But cap rate, we bought at 8.06 versus the market norm of 7.14. And that is quite relevant because remember, the higher the cap rate, the lower the price of the building. The lower the cap rate, the more expensive the building is. Thanks, Alec.
So I think if I can just talk about this, and that is the leases. So as you can see, one of the key things for OrbVest is what's known as rollover risk. Rollover risk really means when you have a mix of tenants in a multi-tenanted building, which tenants are going to be expiring in terms of their leases, what is the likelihood of renewing it, and will you be able to maintain a full building? We have 2 offices in America, just by the way. The one is in Manhattan, the other one is in Atlanta, Georgia. Andrew Fotis, who's been in real estate for 25 years, our acquisition manager here, He is flying through, as Justin said today. He's meeting a whole lot of people there. There's been a strong expression of interest in the space because, as we've said, it's on the campus and in the medical corridor, and it's a destination hub where people would like to get into. So we are very comfortable that not only do we have 2 AAA Moody's tenants, but also there is limited rollover risk. And when we say we look for opportunity, it's the fact that when we look to sell after 5 years, is there enough what we call meat on the bone for the next buyer to buy it to also enjoy their 5 years? And so this is a great opportunity for us with a long lease with such a stable tenant. And so we're very comfortable with the tenant mix currently. And the further value add is if we can get an even further diversified mix of tenants, that would just add to the value proposition.
Yeah, we don't have to spend too much time on this slide, Alec, but here is the 2 really key tenants, St. Luke Medical Center, the Stewart Healthcare Group, and Maricopa Community Colleges. I think we've said enough about those, but it gives you a bit of an insight into the size of those 2 groups. But this is super important. The important thing to note here is, obviously the overall value that we are paying and spending on the building is 10 million, made up of 8.6, which is the purchase price, and you can see there's a lot of provisions there for tenant installation, leasing commission reserve. So everything is provided for, even in the event that we don't need it. But as I mentioned, the key thing to look at here is loan to value. So gearing is very gearing is very important in these buildings. If you are always tempted to gear it more, Alec, because the money is cheap that you borrow in senior debt, but expensive that comes in from equity. So the tendency is to push the amount of borrowings up on the building. We have a limit, and this building is very comfortably below the limit. So the loan to value here is only 57%, and the debt coverage ratio is also well within our defined parameters. So those are the 2 numbers that really matter. And I think we might get questions on the slide later, but the equity that we're raising is 4.16 or 4.2 million, and that's all we really need to speak about there, Alec.
So maybe I should just jump in here and give an illustration. So people always want to know, what does it actually mean? Because most people on the webinar today are not familiar with investing overseas. And so when you invest overseas, I just want to take you through how it actually works from a simplistic perspective. So remember, what we do is we help people and take them by the hand, and we get them to invest directly in a deal in the United States. And so we've got the structures where your money flows through our structures into the building, and you become an owner of real estate. So for example, if you put in $10,000 and we say that you're going to earn plus minus 8% per annum, you'll see that you'll earn on your $10,000 approximately $800 per year. That's your cash dividend, known as cash on cash. Then after the 5 years we sell, it generates a profit. And in terms of the overall returns, you can see at the bottom there's a pre-tax and an after-tax number, and that gives you your combined returns per annum. And I think that the one thing that people are often surprised about is the question comes up, how do you end up generating 8%? It seems almost too good to be true. Not only have we done it for 6 years, but if you think about this and you take a 6 or 7%, which you can buy across the whole United States in many asset classes at that price, and then you gear it using a 65-35 loan to the amount of money you're putting in equation, that's how you get your 8%. And it's something that is completely not only doable, but everyone does it in the United States.
Obviously, there's a few risks, and let's just talk about how we mitigate against them, Alec. So first of all, tenant can default on lease payment. I think the important thing is we do a substantial due diligence onto the tenants, and in this case, we've got the S&P and the Moody's AAA rating on 56% of the lease for the next 10 years. So we're very comfortable that that risk can be contained. Interest rates, they can move up and down in the USA. We fix for the period of the loan, so we fix at at a super low rate. I think we're getting 3.25 in March, around about there. Hopefully on this building, I think it's still going to be finalized. But you know, certainly if you're from South Africa, this part of the woods, you know, that's an exceptionally good interest rate. Valuation risk, market condition can influence the timing at the exit. In other words, this is a very common question that comes up. What happens after 5 years? Can we always exit? And there are a couple of things that matter. As I mentioned, the lower gearing, the loan to value, we always make sure that that's below 65%. In this case, 57, I think I quoted. Debt coverage ratio, very important that you have enough runway to make sure that in the event that one of your tenants doesn't pay for a couple of months, you can still continue to cover your senior debt. And then obviously we make sure that we get senior debt from significant and well-capitalized lenders so that they don't end up with any sort of financial issue. And ultimately, the one thing that's actually not on here is the fact that it is in this growth corridor. So there is always going to be sustained demand for this type of building in this area where there is such growing demand for healthcare and biotech. Lease up risk, there is some vacancy, and as I mentioned, there is that current dark space. We're not concerned about the dark space because it is a significantly large hospital group, but it does give us an opportunity to replace the tenant if we can find better tenants over the next 3 years. And there is some risk in that. The vacant space, can it take longer than anticipated? Yes, it can. But you know, we normally look for good partners on the ground, and in this case, certainly we are engaged with 2 big groups to look after the property for us on the ground. And you know, there are extensive options to extend the lease agreements that already are in place. Ground lease is a very big question that we often get. Ground leases are very common in the US, and particularly this ground lease is very interesting. All the ground lease is there for is to ensure that you don't use the building for any other purpose other than medical, because it isn't a medical campus, and the intention is to keep it like that. So we pay $100 per year in order to ensure that we comply with the ground lease requirements. So that's all from me. Martin, maybe you want to just wrap up on this building.
So the first thing I just wanted to add is we often get a question, what if interest rates do go up? So when we peg our debt, which is like what you would know, a bond or mortgage, is that it can go down, it just can't go up. And you'll pay a slight premium. Remember that the wonderful thing in the United States is you're paying between 3 and 4% on your money that you borrow from banks. And you know, it's at very favorable terms over 5 or 7 or 30 years, with even a small interest component up front in the first year. So debt is very affordable and very achievable in the United States. And just to bring this all together, you know, we believe that this is a great opportunity because number one, of the location, we've spoken about it, we're getting it below market, we're getting it off market, and we're also getting it with a very good cap rate. A cap rate means the rate that you're buying it at, certainly, which is very, very competitive. And then in terms of the tenants, we've spoken about them, a lot of value add in this building, which means there's enormous upside over and above your normal cash dividends. And certainly we believe that the cash on cash and the profit that we will generate bringing together the IRR over the 5 years is certainly very achievable and also attractive to our investors, not only in South Africa, but around the world.
Fantastic. We've got about 21 questions, so we've got about a minute a question. So I hope that many of these questions have already been answered, but let's give it a crack. What about probate? Michael asks that.
Not sure what Michael means by probate.
Do you know anything, Justin, about that? Probate? I've no idea. I thought it was a property term. Anyway, okay, move on to the next one. What investment options are available right now? From Simon. Well, we know there's this one. Are there others, Martin?
So there is a option that we'll be bringing to the market or deal in the next 2 weeks. I'm going to keep the lid on that also. We like to keep these things under wraps until we've actually signed the letter of intent, and which is known as the LOI and the PSA purchase and sale agreement. And then we've had tremendous success in our ODH product, which is our single investment into a pool of our assets. And as you know, we've introduced that in South Africa only to South Africans in the last 1.5 months. And we've been absolutely thrilled that ODH 1 was oversubscribed. ODH 2 was also oversubscribed in a very short space of time. So there's a very good chance we might end up seeing ODH 3 quicker than we expected. I just want to also clarify to everyone, when we say oversubscribed, it might still be on our platform, but it means when people call us and say, but you're saying oversubscribed still available, it means the amount of people that have committed and have actually put their name down are in the process of either being FIC'd, AML, KYC, and moving their money is more than the amount we're raising. So at that point, we technically tell our sales team to stop raising any more money.
Peter asks, please could you cover how the management team incentives and carry works?
I'll take that then. So the management team incentives are very closely aligned to the actual performance of the deal. So what happens is we make a small amount in terms of a due diligence fee up front, which is used to manage our operations around the world. It is a small amount. And then in terms of your asset management fee, you'll notice that our asset management fees generally on our projects are 0.3 to 0.5% versus industry norms of 1 to 2%, which means it's very low. Where we like to be aligned is on the back end. If the building makes good profit at the end, we make money together with our investors. If it doesn't, then we don't make what we obviously projected. So that's in terms of the alignment of the management and the incentives.
She has a follow-up question which says, and management invest alongside in the opportunities, i.e. not only a free carry.
Yes, so OrbVest invests normally 1.5 to potentially up to 3% per deal, and very often the executive team ourselves will also invest into each of these deals.
Philip says, I've been hearing from people lately that Seychelles also has corruption problems. How does this affect the investment of investors?
I'll take this one. So the Seychelles is like any other exchange in the world. It is part of the World Federation of Exchanges. And so there is no difference between the Seychelles, Mauritius, Guernsey, BVI, Cayman, or any other exchange. And in terms of the Seychelles Stock Exchange, it in fact is one of the fastest growing exchanges in the world. They've got a great reputation at the moment. And certainly for not only South Africans, but international investors to invest via these exchanges has been really an amazing achievement in terms of it being compliant and simple and easy. And it achieves the objectives of allowing people to invest into the US and to receive their money from the US.
I don't know how many of these questions we're going to get through, but they are flooding in. Dominic asked, and by the way, I'm only using first names, just in case people don't want to be identified in their full names. So I've got the full name here, but I'm only going to use the first name. So don't worry, you remain fairly anonymous. Anyway, Dominic asks, can the aging American population still afford proper health care?
So I can certainly take that. So, you know, being in the US, healthcare is very expensive. But remember, there's always things like Medicare, Medicaid, which is free to pretty much any person that can't afford it. And you'll see it's very contentious in the US elections. So 93% of the entire population is covered by insurance. It's just a form of something you accept in the US. The very first day you put foot on this country, you make sure you have insurance, and people can afford it, and the cover is exceptional.
Yeah, I can even add to that. You know, there is something that perhaps is might sound a little bit crass, but you know, if you are ill or you are in need of healthcare, you will find the resources, Alec. And it just so happens that that aging population also is kind of boomers, and the boomers have done very well over the last sort of 40 years or so. And so, you know, it is a relatively affluent group of people, and they will find the resources to pay for the medical care that they need. And that's backed up by the fact, as Martin said, that there is this broad-based medical insurance that you basically make sure that you participate in, plus Medicare and Medicaid, I think that absolutely answers that question.
There's a follow-up question here from Johan, who says, what impact would ending of Obamacare, which Trump is threatening, have on OrbVest's returns and security?
If we had a chance, I would show that lovely slide that shows US healthcare over the last 50 years. And interestingly, it tracks GDP almost running at like 1% above, no matter who comes and who goes. So, we are fairly confident that Obamacare or Trump's version of it will have absolutely no effect on the spend or the way that it is happening. I think the bigger question, Alec, is what is technology doing and how is technology affecting the way that medical services are being provided? And that's a fantastic and interesting conversation, perhaps for another webinar.
He also asks, Johan, what would the outcome of the USA elections have? I guess you've just answered that, Justin. Whoever gets in, they're still going to have to pay for medical aid.
Correct.
Terran asks, hi, has demand for elderly healthcare decreased due to less of an aging population in the US attributed to a high elderly mortality rate from COVID-19? Yeah, I think that's.
So I can take that. So I think the first thing to understand is the enormity of this country, and even for myself, it just continues to amaze me. This country is 330 million people. So to lose any life is terrible. The US lost 200,000 people, which a lot of people are saying, if it wasn't for COVID, how many would have unfortunately passed away due to normal illnesses and the flu? But notwithstanding those kind of contentious discussions, one has to understand that this population is growing, it's getting older, there is demand for healthcare, there are not enough facilities envisaged for the next couple of years. So I'd much rather be in a resilient, recession-proof building in healthcare than in hospitality or retail or other sectors that have been hit. By the way, over the COVID period, we have continued to collect above 95% of our rent, and we've said for 6 years, if and when a recession arrives, you'll want to be in healthcare, and our strategy's been proven.
Paul's question, and he wants to stay anonymous. He says, okay, so if a South African citizen has cash in the country, say R1 million, and 100,000 euros offshore, how do you go about investing into this? Are the returns repatriated to South Africa, or can they be left offshore? In either case above, and are the returns paid annually or at the end of the 5-year term?
Alec, great question. I think there's 2 ways that you can invest. Obviously, we don't take any investment in Rand. So the first thing is, if you're a Rand investor, you take advantage of your allowance, get hold of your bank or your Forex broker, and you can move the money into a escrow account of PKF Capital that we use in the Seychelles. And it's as easy as that. And the rest you can do online, or obviously with the assistance of one of our financial managers. But if you have offshore funds and you are, for example, an accredited US investor, you can also go in via our SEC filing reg 506C. Doesn't sound like if you've got euros, that is the case, which is great, because the most efficient way is to go in via the merge exchange. So it's super easy. We've got, as I say, this online platform that you can literally go and do it yourself. There is a little friction, unfortunately, because you have to do this very strict KYC AML process. So we need your certified versions of your ID, etc. But I think that's pretty normal if you're doing any international investment.
So just to clarify on that, Alec, is that a person with funds overseas, most people would like to get their money offshore, and we've spoken at length about that. So getting it offshore nowadays is very, very easy, and I really encourage, not even if you're going to invest in OrbVest, move your money offshore, get it into safe havens. You can do it through OrbVest or other companies, and yes, it goes offshore, it remains offshore if you've done it in that specific manner, and your dividends are paid to where your trusts or structures are offshore.
You'll see I'm chivying you along because we've got 15 minutes and 30 questions. So Meryl asks, when you invest in OrbVest, do you invest in this particular building or all of OrbVest's assets?
It's in this particular building.
Could the Biden win affect the returns, e.g. taxes? That's from Tony.
No.
Martin asks, please explain the alignment. Thank you. Now we're getting somewhere here. Between investors and OrbVest. I'm joking. You really don't have to push that fast, but please explain the alignment between investors and OrbVest. 1, which fees do you take upfront and ongoing? 2, do you make any profit through structuring on day 1? And 3, at the end of 5 years, what's the difference between gross, before all OrbVest fees, and investor net fees? And then 4, how do you invest alongside investors? You want to take them one at a time. Number 1,
So
which fees do you take up front? Yeah.
So the first thing is, when you talk about alignment between OrbVest and the investors, remember the buildings are always housed separately. That's to protect investors. So OrbVest, the company, is not the buildings. The buildings are structured and housed in their own LLCs, which is like PTYs, as you would know in South Africa. And so the second thing is that the fees we take up front, the due diligence fees, are to make sure that we can make sure everything is covered, our legal costs, our acquisitions around the world, our structures, etc. We don't make any money up front on the building itself. In fact, that is for a fact. We don't make money up front. It covers part of our expenses. Then in terms of the monthly fees, the alignment is that we take an asset management fee, otherwise known as AUM, assets under management. And those fees, those monthly or annual fees, are very small. They're, I think, $2,000 to $3,000 a month, which is equating to approximately 0.3%. There is a small amount we earn above a hurdle, but again, still it's below market. And then, as we explained before, the bulk of our benefit of these buildings is when they're sold, we make a nice profit along with the investors, and that is our model, and it creates good alignment between us and investors. They win, we win.
Sajid says, is there capital growth over the 5-year period? Do I receive my initial investment back together with capital growth, or do I only receive the annual returns and the capital growth is retained by yourselves?
So I'll take that one for a change, Mart. So yes, absolutely. There is capital growth, and I think, as Martin explained, you earn the cash in cash, which is basically the return that comes from the rental that we earn in the building. At the end of the 5-year period, we sell the building off. Rajid, we have added some value, and it might be through some escalation in the rentals, it might be through filling vacant spaces or improving the tenant mix. And ultimately, that is where we are really, really incentivized to grow your value of the building for you. And at that point, we sell the building, we take the capital growth and we distribute it back to the investors, and we take a share, obviously, and that is paid out as a dividend.
He's got a follow-up question. What would happen to my investment if you don't achieve the minimum capital that you need to raise in order to get this venture off the ground?
Absolutely, that's an easy one to answer. The investment doesn't get released until we close. So just to let you know, we sign the sale agreement, we do due diligence, and then we get to the closing date. At the closing date, if we haven't fully subscribed the building, then we cancel the deal. Obviously, we cancel the deal because there is no deal, and all the money gets refunded by PKF Capital directly to the investor.
Here's a question from someone who's looking very seriously at it. Merrill asks, why is St. Luke's Hospital not using the facility when they're paying for it?
So it's quite common in the United States that a lot of these very big players sign leases. They're all across America with enormous facilities. Sometimes with COVID, they'll close it down for a couple of months or even a year, and then they'll reactivate it again, because bearing in mind, sometimes in America, with your labor costs, it's more expensive to run a facility than not run a facility. So if you look at most of the buildings in America right now in New York, most of them are closed. People would rather just pay the rent and wait until COVID passes. So whether they come back in or whether they continue to pay for 3 years, it is common practice in America.
Graham says, can institutional or fund investors participate?
Definitely.
Johan says,
on some of our bigger buildings, we actually even offer a corporate or an institutional slug, which comes with a slightly different waterfall, but happy to engage.
Johan's question says, if the building increases in value over 5 years, does the profit accrue to the building's investors? Historically, what percentage or value has this bonus been?
I'll take it, Mart. It ranges from 50 to 60 or even 70% in certain circumstances. So the balance, in other words, the 30 or 40% goes to OrbVest and any other shareholder that we may have or partner that we may have on the ground. For example, if we partner with one of the big groups, like we mentioned earlier, we would obviously cover them with some of that benefit as well. So the answer to the question is, it's a separate company. All of the profits of that company gets returned to shareholders, less our slice of the action.
So Alec, if I can just jump in there,
of course,
because it's a question we sometimes get asked, and people don't understand how you can achieve these kind of returns. And so I just want to give a very basic example which explains it. So if you bought a building for 10 million, and we say it increases or you generate 50%, it doesn't mean that the building goes from 10 million to 15 million. It means if it went over time and grew by 4 or 5% an annum, that would take it over 5 years to a 20-25% growth. So it means your 10 million building would go to 12 or 12.5. Remember, you only put 4 million equity in. So if you take your 2 million profit and you've divided by the 4 million equity you put in, you've generated a 50% return on your money, which is quite phenomenal. And that's why it's just important to understand that equation as opposed to thinking the entire building increased by, call it 30, 40, 50%.
Tony's question is, can dividends be reinvested?
Absolutely, Tony. The way that we handle that is we pay the dividends into your trading account, which is, we call it a wallet. By the way, you can track all that on the platform, so it's really cool. You can watch the money going in and out. And you can choose to reinvest it by 2 or 3 clicks on the website, or you can choose another click and that draws it out back into your account wherever you are in the world.
Alec, if I can jump in here, one question that we didn't answer, which was the first question about probate. So probate generally refers to someone's will or whether it'll be valid. And remember, when you are investing via your Seychelles structure or your structure, it is not impacted in the US because it goes in, all the funds go into our structures as a single payment via the OrbVest structure. It comes out. So you are not a direct investor in the United States paying tax in the United States. That's the beauty of our structure, which means that if you have an estate and God forbid something happens to you, via the OrbVest structures, it will be paid directly to your estate, wherever that might be, and it needs to pay the appropriate tax in whichever country you've put your structure or in South Africa.
Brilliant, because we had a number of questions on that subject as well, so I kill them all now. Costa asks, how landlord friendly is the state of Arizona? And he follows up by asking, could you please provide more detail on who the partner on the ground is?
So in terms of all our states that we operate in, specifically if you look at Texas, Georgia, we won't go into any states that are not landlord friendly. So that's one of our first investment criteria. We've got an enormous list of criteria before the independent investment committee will even look at a deal. So it's not done by Justin and myself sitting in a room. It's done by guys in South Africa, as you know, who've got long reputations, and it's a very thorough process. The second part of it is in terms of the partner. We have always built relationships with the best on the ground. We've been working with a number of people. Andrew Fotis, who's actually on a plane today or tomorrow over to Phoenix, is meeting all of them. We know most of them, but we'll make our selection based on who's the best in that area, because they are generally intertwined into the community. And so it's very easy for them to lease up these buildings when you are intertwined. And remember, at all times, we have a step-in clause. If they don't perform according to our expectations, they're out, we bring the next person in. Thank goodness in 6 years, we haven't had to do that.
Mike, but perhaps it's worth just mentioning the names of some of them, because some of the investors might be familiar if they are property guys. I think we can.
Sure. So in terms of, I mean, it's very well-known players generally across America. You'd get the Remaxes, the CBREs, who's the largest in America. You've got, you know, Collier's, You've got all the big players. And then, of course, we've got a strategic relationship with Lincoln Harris, one of the largest companies that manage healthcare assets in the United States, worth billions and billions of dollars, and a presence across most of the big states in America. So these are the kind of guys that we have a relationship with. They are able to step in and make sure these buildings are well managed. And this is what they do every single day of their life.
Yeah, and of course, JLL, I think we are speaking to in that area at the moment.
You've done brilliantly. I've been going through the questions. Most of them that are left have been answered in one way or the other. There are a couple more, though, that we'd like to finish off with before we close today. Vincenzo wants to know, what are the details of the legal structure of the deal, ITO ownership of the property?
So maybe the easiest way to explain it is that what we do from this point onwards to everyone listening is the next step is, do you really want to move money offshore or not? Or do you always want to be beholden to the rand? That's what I always say to people. And when you dip your toe in the water from even as little as $5,000 up to $1 million, it's quite simple. You contact OrbVest or you go to www.orbvest.com. What happens is you register. One of our relationship managers will immediately get hold of you. We'll take you through every step of the process, what the structure looks like, how we do it, how your money flows, how it comes back. Remember, all the people we deal with around the world are high net worth individuals, certainly in other countries. They all have the similar questions. And so it really is important that we spend as much time with you as you need to go through and make sure you're comfortable before you invest. But suffice to say, anyone listening now could be invested in this building within 7 days. Justin, you want to add?
Yeah, absolutely. I think maybe the concern is what ownership do you have of the the actual underlying property investment LLC? And I mean, the simple answer is, if you put in $1 million on a $4 million raise, you own 25% of the equity of that SPV on the ground. So it's you get direct equity in the property through the structuring.
Final question.
That structuring. So just to give you a very high level view, in that in America, the way it works with real estate is you have an SPE, special purpose vehicle, which then buys the building. And above that, you then have another vehicle that manages it. And then above that, you have the investor LLC, and it's called a blocker. And then what happens is the money comes in from our channels. It comes in cleanly and transparently, all disclosed up front in our documents, and then it flows back the same way out.
The final question comes from Brett, who wants to know about inflation. How does that impact it? It's looking to be going up in the USA. How will it affect the returns, and how do you increase the rentals if inflation would arise there?
Justin?
Well, I think we do build in an escalation. It's not like South African escalations. We don't get 6 and 7, 8% escalation there. Normally, it's kind of 2.5% escalation per biannually, So I think that's how we try and estimate what that inflation will be over time. Can we exit in the event that inflation runs? Unfortunately, we can't. As far as I know, there's no way in this particular building that we can exit the lease because of inflation, or whether we can get more money. But I think what you do need to understand is net operating income is basically the income that you derive outside of the operating costs of the building. Operating costs are normally pegged to exactly what those operating costs are. So your utilities and your maintenance and your cleaning and all that would be managed separately. So effectively, it's your return on investment that is constant, and that wouldn't change irrespective of what the inflation rate was. But your utilities and your maintenance and your operating of the building, that would be passed on to the tenant.
Alec, if I can just jump in there and say that for people looking at many of our brochures, you'll see that we seek to acquire buildings that are known as triple net leases. Triple net leases, essentially what that means is that it's very basic. You've got your 8 or 10 or 2 tenants that pay your revenue. You've got your basic expenses that don't really change. And anything over and above that, the tenant pays the pro rata share of those expenses, regardless of what they are over time. So we don't incur the costs. They pay for it. It's known as a triple net lease.
Before we go, gents, final word from you, Justin.
Yeah, thanks, Alec. I think that we would love to speak to any of you that want to engage, that are interested in our product. We are super excited. We think that we found this niche that really works for us and that matters. I certainly go into every single deal that we offer. I hope we don't offer too many deals too fast, because I might run out of money, but it just so happens that that's the way that we believe in our own product. Yeah, get hold of us. It's very easy. OrbVest.com. Go and make a noise there. We'll find you. Alternatively, you can contact us through. I think there's a web form here that you can register through on your show. Yeah, Alec.
Yep, it's on there. It's on the chat box. So if you have a look at that, that gives you the YouTube channel, and that's where the recording is going to be. And then Stuart can just, there'll be plenty of links through from BizNews. So we are partners, and you'll be able to find your way through to OrbVest very comfortably. Martin, final word?
Alec, I just want to say thank you to you and all your listeners for giving us your time today. As OrbVest, we've seen tremendous growth over the past year and through COVID. We've been trying to get into Arizona for, as I said, going on a year now. We're thrilled with this asset. We don't believe it's going to be on the platform for long. People who do want to obviously invest into it, I encourage you to move quickly. And I just want to say that we really look forward to running this asset and seeing the dividends flow over the coming years. Thank you very much.
Thank you, Martin. Thank you, Justin. And sorry, Justin.
Sorry, Alec. Yeah, Stuart just posted the link on the bottom there. If you perhaps can show it there.
Very easy. Go into the chat box, click on the link, put in your details, and you'll get the guys' full attention. We've had, a number of people are very excited. Neil says, okay, so there's no free carry. I'm in. Sign me up. Graham says, how can we re-watch this webinar? Well, there's also the BizNews channel there. Very easy. Go to Google, put BizNews and YouTube, and away you go. Andre also says, thank you very much for all the information. Sounds great. And then Johan, brilliant webinar and an exciting investment. Thanks a stack. Well, thanks a stack to you, Johan, for being with us. And of course, to our dynamic duo, our appreciation again for spending the last hour explaining number 29 in the process. Until the next time, Justin, Martin, cheerio. Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. A recording of this webinar will be available later today on the biznews.com channel on YouTube. From our team, until the next time, cheerio.